Hello, friends. Welcome to Nirmal. I am Piyush Jain, and today we are bringing to you in our series of conversations with mutual fund managers, market veterans, industry experts. Today we are bringing to you a conversation with Ms. Lakshmi Iyer, CEO of Kotak Investment Advisors Limited. Lakshmi ma'am, welcome to the show.
Thank you, Piyush.
Now, let's start with the markets. Last year again was full of events, full of volatility. Our Indian markets sort of managed to sail the course. This year, how is it looking to you from an Indian markets perspective, from a top view perspective? How is the overall scenario looking to you?
So for starters, I think the top-down view is getting largely dictated as we speak by more, a confluence of global factors with, some sort of an overlay of domestic factors. More specifically, I would say it's a global landscape, whether it is some sort of an event risk or a more, I would say, global inflation-led risk. I think it is being driven more from that perspective. And while we can say that India, in some sense, is an oasis in the desert, one can't completely wish away the fact that there will be some interlinkages which we cannot do away with totally. So I think it's going to be a slightly more fluid situation. Where overall money making across asset classes, both whether it is equities as an asset class or fixed income as an asset class, is going to be constantly oscillating between, what is going to hog more center stage, whether it is global factors or domestic factors.
Right. So now let's start looking at the blocks here. Last year we got a war. The war is still continuing, but at that time it was at the center stage of discussions. Then because of war, we got some fund outflows from the FIs. Market still again sailed through. Then we got very sharp spike in inflation across commodity inflation, induced inflation spike. We got interest rate spikes. Now basically as we have moved we've digested that and we have moved into 2023. What you're expecting now from a sectoral perspective or from a broader market perspective, are we looking sort of continuance of robustness in the economic activity, or you are sensing some slowdown, or when you my question summary would be, when you're looking at a portfolio construction, what is coming to your mind?
So right now, I would say two things come to mind when you are constructing a portfolio. A, what are those sectors, since you mentioned sectors, which will be less globe dependent and more domestic consumption dependent? That is number one. And number two is obviously what are those segments or sectors which could potentially be a beneficiary of the capex cycle, which probably, after a long hibernating phase seems to be kickstarting right now. So I think these are the two key, I would say, focus areas from a portfolio construction perspective. Another or third very important overlay and important factor to be considered is we have seen continuous and relentless rate hikes by central bankers across the globe, including India. And at some point in time, we are likely to see, especially this year, some sort of a plateauing out on these interest rates. Will the central bankers pivot or start towards, bending towards a rate cut anytime soon? That remains to be a big question mark, given that inflation is still very sticky. But clearly, plateauing out is a trade that one can play on one's portfolio pretty deftly in this year. So I think these are the broad 2 or 3 areas which one need to keep in mind while building a portfolio this year.
So is it like the debt funds or the bonds? Because I was just listening to you and I was thinking if we have reached the peak, the rate cuts might or might not happen. But if you have reached the peak in terms of rate hikes, it also gives an opportunity to lock in the yields which we are getting this year. So is this something where actually this year with the bond funds or again any type of debt instruments, is that something which is offering some attractive opportunity?
Bang on, Piyush. I think you hit the nail on the head. It looks like we are, as I said, maybe towards the fag end as far as the rate hike cycle is concerned. And given that markets tend to run ahead before the central bankers rush to act, if that kind of a scenario, it looks like the April rate hike, if at all that happens, is already discounted in today's market. In that scenario, I think investors could look at locking into these kind of rates, given that the outlook, as I said, the change happening, the chances of getting a rare-ended capital gains on your fixed income allocations this year could be very high. So start constructing a portfolio which has a combination of actives which allow you to participate in this market movement and secure yourself with some kind of a comfort of passives where the predictability of the rates, given that you may invest in a sovereign kind of an underlying, the predictability of the rates could be reasonably high. I think this combination is what is clearly warranted in this sort of a scenario.
Right, and I'm truly cognizant of the fact that it sounds very easy, but I know when you are sitting at the right active desk, decision-making desk, it slightly becomes tricky. Tricky from the perspective that, as we just talked about, bond funds or debt instruments, they are offering attractive sort of returns here. But when we compare this to the equity return outlook for this year, and I know when we make portfolios, it is for multi-year, but when we sit in 2023, on a comparison basis, how's the equity outlook looking to you?
So clearly, two parts to this question. One is if you are looking at valuations of Indian equities from a global perspective, clearly the premium is high. Have they historically traded at a higher premium? The answer is yes. But of course, it's a matter of degree. And given that, obviously, some sort of a realignment is what we are seeing underway. So year to date, already India has relatively underperformed its global peers, and with some sense of, I would say, an impending, I won't say growth slowdown, but some sort of a plateauing out in terms of the earnings in certain sectors. The risk-adjusted returns, at least for the next 2 to 3 quarters, on a broader, 12-month period, clearly seem to be skewed towards a fixed income allocation. But I must hasten to add, as I mentioned to you earlier, that we are looking at portfolio construction to be there as a mainstay for the next 3 to 5 years. In that context, however, 2023 could be the year of accumulating quality funds, quality stocks into your equity portfolio and run it for the next 3 to 5 years, because there is no denying the fact that even right now, in terms of an outlook or a forecast basis, the potential student of a year from a growth standpoint still stays with India.
Right. Now, let's also talk about two questions, two topics I think which a lot of investors, a lot of viewers actually would be looking and thinking around. One basically is what we have really started seeing in US, which from the perspective of one bank, two bank, more institutions, but it looks like there is a bit of tumultuous sort of situation out there, primarily because of interest rate hikes, then associated mortgage linkages. But whatever we say, sitting here, what our viewers should really think, is it something which can really sort of escalate from a perspective of any sort of fund outflows or any volatility in the markets? How you read into that?
So, my urge to all the investors is don't behave like a Begani Shadi mein Abdullah Diwana kind of a moment. That is point number one. Yes, as money managers, as investors, we need to keep track of what is happening globally. But to excessively react based on that on your domestic portfolio is not something which is warranted. So that is point number one. Point number two is that yes, the US authorities have definitely been swift enough to act and resurrect the situation even as we speak. The situation is going to be evolving, but it has impacted one set of the investors one set of the fraternity. It is not a function of what we have seen in the previous years, a series of bad loans which have emerged. It's nowhere near close to that sort of a scenario. However, it has clearly exposed the kind of fragility of the system out there in the United States. So I think it's a combination. It is giving investors an opportunity that if you believe that the fundamentals in India are intact, which I would say is the case, then this is the time to keep your dry powder, your ammunition ready, and cherry pick the opportunities which you always wanted to pick from the gamut of things which are available. We need to be mindful of the fact that central bankers will be reluctant to pedal, go into the fourth pedal in terms of the rate hike accelerator as far as the US is concerned. Knowing well the fact that inflation is still way above their target, but it is going to be an extreme tightrope walk, given that, at least from the country's standpoint, it is a significant risk which has unfolded in the last 48 hours.
Absolutely, and I think that's the point which our viewers needed to hear, and also our viewers should remember we're talking about SIP every month, about 15,000 crores. And ma'am, 15,000 crores every month, correct me if the number is wrong, but if we are talking about 13 to 15,000 crores of SIP money coming into the markets every month, on a year basis, the number again still looks quite a good number. Is this something which is providing a good sort of cushion to the market?
No, undoubtedly, the retail participation in the equity markets are a very strong anchor. You will also note that this category called balance advantage funds, on an average, equity exposure in these funds is lower end of 45% to higher end of about 55%, with the average being close to about 50 odd percent. Now, imagine if there were to be sharp downfall or a downward movement in the market, some of these model driven funds will actually look to allocate at appropriate times. So you have multiple levers of cushion over and above the terminal benefit funds, also like the EPFOs, who do allocate to equities within the limits that have been prescribed. So I think it is therefore, as I said, to time the market is a great quality of a lucky person or a liar, and I don't know how many of us can claim to be either of these. But for everyone else, I think it is the discipline and not succumbing to greed and fear that will ensure that wealth creation, despite all these hiccups, are not really hampered.
Right. Now, from the top view, let's start going into the thematic and the flavor of the season here. From a sectoral perspective, right now, what are you liking?
So we continue to like the banking as a segment, more the banks and not the entire financial services pack as a whole. There is reasonable amount of resilience credit offtake as we are seeing and tracking after again a good gap of single digit growth is clocking in mid-teens kind of a growth on aggregate basis. They are raising funds in the market. There is a deposit growth. Of course, deposit growth is lagging credit growth. But clearly, amid all this tight liquidity scenario, at least the resources are available from a bank standpoint, and asset quality as such is not so much of a challenge even as we speak. So I think that category clearly holds a comfort space. Cherry picking, of course, is the buzzword, and there is no exception to that. For that matter, any sector. Capital goods is another segment that we are comfortable. We have seen the kind of capex thrust that this budget has brought in front of us. So I think that's another segment which we like. IT is a segment. Of course, it's not that largely IT companies in India are service oriented, compared to say US tech companies which are more product focused. But clearly, initial signs of tracking these, given the fact that 2022 was not a great innings for the IT pack as a whole. So maybe with a lag of couple of quarters, you could see some cherry picking opportunities in this space. And then, of course, the theme, as I mentioned, those sectors which are largely domestic consumer dependent, and to a lesser extent vulnerable to global movements, I think those sectors will continue to find favor in the investor's portfolio.
Let me actually start from a consumption point of view. When you are seeing consumption, it is largely FMCG staple consumption, or you're talking about discretionary consumption.
See, discretionary right now is showing a mixed trend. There is, certain initial pockets where there is absolutely no impact in terms of consumption demand. But even in the latest result seasons, we saw a couple of companies sound a little bit cautious. I won't say downbeat, but a little bit cautious as far as consumption demand is concerned, as far especially the discretionary demand. But I think it's more of trying to find out those sweet spot, those pockets which will still continue to rule. And in that space, therefore, between rural and urban, clearly urban seems to be scoring in terms of its demand. Though, as I said, there are pockets where there seems to be a little bit of caution from, say, absolute upbeat mode to a little bit of caution. But I think it is this space which is likely to be the harbinger as far as the next growth drivers are concerned.
Okay, so that's about consumption. On the IT, uh, the big debate has been that where we actually should be really focusing upon, is it the old large cap IT delivering service and 20% plus minus 2-3% returns here and there, or we are talking about the mid cap, the product companies, where you are thinking that perhaps value could be made.
So I think, Piyush, it would be a combination because we have seen that the old age entities still continue to be dominant players in their respective segments. Of course, we've not really seen any massive upbeat guidances as such from any of these, but the answer clearly lies. It's not going to be a carte blanche ownership of that sector. It is going to be a mixed bag where you are going to mix and blend the old and new age together, depending on where you think there is going to be a less vulnerability with respect to the global headwinds are concerned, and more importantly, resilient enough to be able to withstand. We are seeing globally how there are these massive layoffs which are happening, but that was more a function of excessive bench strength which was built up, which is giving way to some bit of rationalization. So I think it is going to be a mixed bag. There won't be a cookie cutter, solution to be able to own this pack as a whole. And which is why, if you see the aggregate of mutual fund tech sector holdings, also some bit of underweight is reducing, but the underweight still continues.
You made a very valid point here. I'll share an interesting insight. During our interactions as a part of our fund manager series, one interesting thing which has come is the IT sector. And I truly believe that there is a sort of interesting trend which will develop during this year, because there is no consensus in IT sector. Some are really bullish, some want to avoid. Some think the second half actually is going to be interesting for IT, like we were discussing right now on IT. But it's very interesting for our viewers. IT is something which is very interesting this year. It looks like from the conversations. But sort of keeping on the trend, and when we look on what is happening in the Indian markets, we are seeing a sort of a trend that the large caps have been very nicely owned. There is no major under ownership. Even if I take a look at the different sort of Kotak category funds, there has been a lot of good performance coming from the emerging equities, the mid cap funds, large mid cap funds. This year, according to you, does it belong to mid caps? Because as we were just pointing out, broadly the valuations have already been met in the large caps.
So what we have been, talking to our investors, Piyush, at KIL, is that you need to look at it from two perspectives. One is that some bit of froth is easing out in the mid-market and the small cap space. So a staggered way of investment in mid-cap and small cap should still continue. The benchmark may not have corrected as much, but the specific stocks in the space have corrected much more, giving you, probably an opportunity to stagger and put your money. Whereas large caps is something which we are okay to tell investors to even do a lump sum, contrary to a staggered mode of investing, given that we have seen maybe a combination of price point and time correction on the frontline large cap indices. So I think the value driver eventually if you're talking about building a portfolio and curating and keeping it for the next 5 to 7 years, I think that incremental alpha generating potential, our view is likely to be in the mid market and the small cap space. And that is why creating the right kind of portfolio, given that the fluidity of the situation still remains. It's not that if you pick up a very compelling story ab initio, it is going to make tons of returns for you. I think that is a fallacy that investors should completely disbandon. But as I mentioned to you, accumulation phase is what we believe a good part of 2023 will offer you. And shy, we must not away in this kind of a scenario.
I'm not talking about my favorite pack, which is the financial pack here. This is where actually you started as your first sort of pick here. My observation across Kotak funds, whether it is multi-cap fund, flexi-cap fund, equity opportunities fund, and that has been, we see common names. I'm taking names, but we'll talk about the sector as I understand. HDFC Bank, ICICI Bank, Axis Bank. So all these, they form as a part of large cap private banks. So now the question comes is, there are three pockets here. One is large cap private banks, and they have been the flag bearers of the financial sector in terms of stock performance. Then there are beaten down mid cap private banks, which had a lot of problems, seems to be coming out of somewhere. And then there are PSU banks, like SBI could be an exception, but then there are other PSU banks here. Between these banking packs here, should the vote of confidence remain on the large cap private banks?
So as I said, our view as KIL continues to be constructive within the entire BFSI space. The view remains to be positive on the banking sector. And within that, again, we do like the large banks, large private sector banks, very, very select handpicked public sector banks, and to a tertiary extent, even the mid-market private sector banks. So I think that clearly seems to be the order, of our preference, and that's what we've been, talking in all our investor conversations as well.
Right. So that basically is very clear. And from a consumption point of view, do you believe that a couple of NBFCs, which were initially also looked as consumption proxy, could be? I'm just picking names to make our viewers understand, like Bajaj Finance, Cholamandalam, we identify for auto finance. Like coming back to the themes, are these NBFCs also something somewhere where you think they can sort of perform if the interest rate cycle is picking it out?
See, the benefit of a plateauing out of interest rates and expectation of rates easing in anticipation of rate cuts, probably more of a 2024 phenomena, should augur well for some of the NBFCs also. But quite a bit of that discounting of the story seems to be already in the prices. So you could see some sort of a lackluster sideways movement for some time before that pivot story actually starts to kick in. So yes, it's going to be absolutely a very selective play as far as that domain is concerned. There could be some mid-market players also emerging to be formidable names in the space. And also, we've seen through the pandemic, quite a few of these balance sheets also got into a little bit of I would say deleveraging, but reducing the leverage kind of a mode. So I think that pocket also can be invoked if there is demand, which seems to be resilient at the current moment. But given that interest rates, hike especially tends to act with a lag, you could see some pockets of demand actually getting subdued as rate increases continue to happen. Therefore, the essence is going to be to see how long central bankers are going to continue this hawkish narrative. And then, of course, as I said, in India, we have a month more to go. and we have a very interesting, inflation data, which is going to be the last one ahead of the monetary policy decision.
Right, that's one point here. And let's go to the popular question, which I'm very sure you have answered a couple of times. Uh, we have seen again over the last couple of weeks what has happened with Adani Group stocks. As a house, as a group, what has been your observation from the perspective of receipts from the sort of subscriptions, or any of your view which has been your observation for our viewers?
Subscription isn't? I didn't understand.
Like, suppose if basically you have actually subscribed to bonds of any of the Adani Group stocks, because recently again they have been sort of paying back all the short-term maturity bonds. So your view on in term from the perspective of how it has been from a market perspective for you.
Oh, okay. No, we don't really have any exposure, so obviously we don't comment on specific groups or stocks. But I think from what I have been tracking of the markets on maturity rates, the capital market exposures is something that they have been reaping. So as such, I don't really see any issue on that front.
Okay, so let's move on, and let's go across to FY24. We are now ending FY23. From the perspective of the last remaining days, is this something where viewers should really sort of look at FMPs? Is that something? I'm just coming back to one discussion which we're having. The last 17, 18 days, whatever it is it a time where investors should really look at locking in FMPs?
Well, you can look at a combination of target maturity funds, which are more open-ended in nature and achieve pretty much a similar objective compared to fixed maturity plans. So you actually have a couple of options to evaluate. Erstwhile, there used to be only the fixed maturity plans, which are totally closed-ended in nature, and you are dependent on the stock exchange at all you want an exit because these are listed instruments. But there is hardly any trading which really happens. So look at a combination depending on what your end objective is, and given where we are in terms of interest rates, some allocation to I would say these are funds which are targeted to close or mature at a stipulated period, and therefore they mitigate interest rate risk to a large extent.
Okay, and let's round up our entire discussion into a sort of an outlook of FY24. As a CEO of Kotak Investment Advisors, how are you looking at FY24? We have seen all the events, the budget giving us an all-time high investment number. We are seeing robust inflows into the market. From a sort of top view perspective for FY24, how is it looking to you?
So my view is very simple, Piyush. We are looking at clearly, excesses getting readjusted, the frauds getting, gradually weaning out of the markets, whether it is globally or in India as liquidity is readjusting itself. So in that kind of, a scenario, clearly there is one country which is standing tall, where inflation, is pretty much projected to be under the RBI's threshold tolerance band. And this is not true for probably any other country in the world, including the US. So the view remains that our country remains an oasis in the desert. It might have its kabhi khushi kabhi gum moments, but the fact is that you need to be an investor for the long term. You need to ensure that you don't really lopside your asset allocation, and accumulate when there is fear on the street, and reverse when everyone seems to be a one-sided follower of a trend.
Well, that's a summary for our viewers, and that perhaps should be actually a sort of guiding light for you for FY24. And Lakshmi ma'am, as always, it was a pleasure talking to you, and thanks a lot for joining us on the show.
Thank you. Bye.
And with that, dear viewers, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.